Hi, everybody. Thanks for coming. I see some familiar faces, and I see some faces that I see for the first time, some newcomers. So let me introduce us. We are the Global Value Investing Club. Um, we operate in several places. The London event is our main event. And let me introduce you our CEO and founder, Rusbe Bata. I think that
You guys can hear me?
yeah. Let me just change the settings so they can. We cannot.
Yeah.
Yeah, we can hear you and we can see you. Just let me just put you on the screen. Uh, yeah, I think now everybody can see you online.
Okay, great. Hey guys,
Yeah.
yeah. Hi guys. It's a bit difficult to see you guys from here. I think from this app, but yeah, nice to see you guys. Apologies, I'm not there in London these days, so I've handed over the baton to Dimitrios, who is, as you guys know, a passionate value investor. So I just wanted to say that I'm really glad that we are continuing our monthly sessions, especially with Dimitrios. And if you guys, anyone in the room or anyone online, if you guys want to present, please reach out to us. We're always looking for speakers. We're always looking for ideas that we can share in the community. So pretty much that's it. And most of you guys have my contact details if you want to reach out for anything. Thanks and enjoy your session. I'll be in listening mode now, and hopefully get some value ideas myself to invest in this market. Thanks,
Thank you,
Dimitrios. Over
Rusber,
to
for
you.
joining us. Thank you. So we can continue. So basically, we have our monthly events in London, and if you go to cityfalcon.com/meetup, you can go and download the past presentations and see what people presented. Also, you can go and check. We are tracking the performance of the ideas that are pitched here. Okay, so you can go and check at the same address, cityfalcon.com/meetup. So just this is a discussion, right? Always is a discussion. I don't want it to be a presentation. Look. So this is the performance of S&P 500. It's a main index. Who tracks this index? Like, do you track the index? This index? Yeah. Okay. So we see that it was not a nice period for some investors. It went down about 19-20%. But if we have a value investing mentality, some of us, if we had some cash, it's a good period because it gives us some opportunities, and also it promises some better returns for the future. Now, these are we just collected the best and the worst performers. So you see here that in a year, you always have stocks that they can, outperform massively. And can you see? Are there any stocks that you can recognize, or probably you have invested, like from the left or from the right side? Maybe if you're from the right side, you don't want to say, but I don't know. It's, yeah. Look, I will come to you like that, so people online can listen to us.
Well, I wasn't going to say much, but I'm saying there's definitely some on there that I wish I'd invested in.
Fair enough. Yeah, but basically, yeah, it's very recognizable, the first one, because of Buffett. But you see that basically it's oil and gas. So an industry that for many years didn't perform well. Most of the best performance are from this industry. And then we see, okay, we see biotechnology, we see, and these are stocks like 800 stocks that Morningstar tracks. So it's similar to S&P 500. It's not exactly S&P 500, but it must be very similar. And something more revealing is this one. Can you see well? Can you? What do you see here? Is anybody that want to to comment anything on what you see? Yeah.
General trend that energy and healthcare are doing better than technology and sort of other industries.
Yeah. So we see what we saw earlier, that in that we see some pockets that they are doing really well, like the oil industry. Also, something interesting is that if you go to the technology sector, it's one, let's say, major stock, IBM, which didn't perform for long, and this one is the only like big part of that square there that has done well after a while. And I don't know why insurance is performing so well. Also, you see auto manufacturers are not performing well, but of course asset management. But does anyone have an idea why insurance is doing so well this year?
Yeah, rates going up.
Huh? Because of rates. Can you explain more about this?
Yeah. So basically, insurance business is you get money up front and you have to invest that money somewhere. And most of the regulators will ask you to keep that money safe. And when the rates were zero, those guys were earning zero. Now they're earning 4%, 5%, and that straight away falls to the bottom line.
Okay, thanks for the explanation. So now, why I'm showing this? I want us to talk a little bit about also global investing, because it's something that it was out of favor. Okay, this screen is from our sentiment page. So basically, with this map, we track the sentiment among different countries. And if you go to this link, you can also see the sentiment for specific industries, companies, and this comes from analyzing the text. So if the text has positive, like um, um, sentences that mean something positive about the sector or the specific company, or if you have positive news for this specific country, it will appear as green and it will appear as red, and you can see that for different periods. So anyway, the reason that I present this is that because I think global investing was something that was out of favor, because S&P 500 in the US markets were going up, up and up, and that made people who invested globally feel like idiots. And even people from the UK or from all over the world, they mainly focus on the US markets. So do you think that there is a trend, or there is more interest now that people show, for example, that maybe parts of the US market outperformance was maybe a bubble, or there was some areas of bubble territory? What do you think? Is anyone any thoughts? Like you're free like to say your opinion. Yeah. Yeah. Sorry.
I was just going to say, similar to what was discussed earlier, I think we had historically low rates for a long time, which obviously sort of turbocharges the sort of multiples that people pay for stocks. There probably was some bubble territory in some stocks. Dare I say, Tesla is one that everybody talks of. Shopify is another one that's obviously we've seen in the last couple of months has been sort of decimated in the market, albeit there's still some quite high valuations out there. So SPACs is another one. We've seen SPACs really sort of take off in last year and have sort of turned to dust this year. So yeah, I think it's kind of really rate driven, really.
Anybody else? Oh, so okay, let's discuss about some positive and negatives. Like what are the positives or negatives from investing in global markets? Like, can you think of I don't know, pros and cons? Like what can you find as a big pros or con? Ideas like why somebody should go like in other places and invest. Yeah.
I mean, these are just my thoughts when I think about investing in other countries. Obviously, there's risk of political turmoil, their governments are different. Um, and then just generally like change in regulation, you know? I feel like I may not have my finger on the pulse in those countries, and so I may not understand how things are going to turn.
Yeah, that's a big truth. Like that, you go to a country, you don't have a good feeling. Like you always have a better feeling for your country if you are not there. But some good parts is that you can diversify. Also, another very main reason is, for example, language. Sometimes language might be a barrier because it's easy for us from the UK. It's also similar culture, similar, yeah. Uh, so it's easier to go and invest in the US or in Australia or in Canada. Like, but for example, you may find a global company in France but it will be difficult to have a good sense. You will have some announcements, maybe some of the annual reports may be in English, but you won't have a full. So it's something that we have recognized it in CityFALCON, and we are expanding our language coverage. Now we are covering 60 languages, and we aim to cover 90 for the first half of this year. And basically, later, something that we aim to do is to add translation. So, for example, if somebody invests in a global company like Vodafone, for example, I'm Greek and I can understand Greek, but they can go to, if they have the company in their watch list, or they can go to the company and see all the news for these specific companies, for this specific company in all languages, which is great, because then you can have a feeling of what is being said about McDonald's in other parts of the world and have a true feeling. So this is something that we have recognized, and we are adding more. And also we include the sentiment analysis. So all these articles, you can filter them if they are positive, negative. And something else that we have done is that we have launched this quiz. I don't know if any of you have done this. You may have received an email, and you may have done it, but we will say more about this later at the end. So before we go to our speakers and go to the action and the real ideas that I think that you will enjoy and we will all enjoy, what do you think? What do you think that? What's the state of the others, and what's your state, and what's the state that we should be? You think, like, do you think that people feel fearful now and we should be greedy? What do you think about that? What's your sense like right now in the market? Are people fearful? Okay, not enough is one opinion. Yeah, it's getting there, but not very, very fearful yet. Yeah. Okay, so maybe we have more room to the bottom. But we are better if we are contrarians, if we don't let those feelings affect us. Sorry?
Last September, it's not quite Halloween yet, so.
Yeah. Exactly. So guys, I'm preparing now for the presentations. Just give me a few seconds. Sorry. Yeah. And I will give you now the microphone. Where is that? I have. Okay.
Okay.
Great. Oh yeah, there we go. Okay.
How about I introduce you first?
Okay, sure.
So, just bring that up. And you can hold also these. So you can check that it works. Yeah. Okay. Right. So we have Stephen Gamble with us. He will present Vertu Motors. He's a value investing enthusiast by reading like other famous investors, and and we can see from the company that he presents that he's a deep value investor.
Thanks. Thanks, Dimitrios. Can everybody hear me okay? All right. Yeah, so my name is Stephen Gamble. I am a value investor. I also like merger arbitrage and net nets as well. And it's really great to see you all here tonight for this meeting. So we're going to talk to you about an AIM-listed company called Vertu Motors. So a little bit about myself. I've been investing in stocks since 2007. And I mentioned the strategies are like Ben Graham net nets, value stocks, and merger arbitrage. Merger arbitrage is buying companies where you have an announced corporate takeover, but the share price isn't yet at the price at which the shares are going to be bought by the acquirer. There's a risk premium because some of the deals don't go through. So it's profiting from that if they do go through. So in May, I launched realworthstocks.com, my investing website. So it's a monthly subscription service. And I give people buy, sell alerts and a monthly newsletter with a stock pick with an in-depth research report. I also talk about mental models too. And also I buy the tips that I make as well and track the performance in a model portfolio, which the members can see the composition of that and the performance over time. The general public can see the model portfolio performance, but not what's in it. So since May 2022, picks are up 10%. And I've got Facebook, LinkedIn, and Twitter accounts. So they're all at the bottom there. You can follow me on those. And there's also a free email newsletter. And if you sign up to the email newsletter with this link, I'll send you my what I would normally send to the paid subscribers, my January 23 newsletter with my January 23 stock pick as a special bonus for signing up. So enough about me. Let's talk about Vertu Motors. So Vertu Motors, their mission statement is here. They were formed in late 2006 to acquire and consolidate the UK motor retail businesses. They're listed in AIM in the London Stock Exchange, and they have 349 million shares outstanding. Here's a map of all their dealerships. See if the laser pointer is working. Oh yeah, it is. I can't see the laser pointer there. Never mind. So the blue and the green dots are locations of their dealerships. And then in December, the 5th of December, they announced a big acquisition called Helston Garages. And they bought a lot of dealerships in the southwest, and those are the orange dots. So they went from 160 dealerships to 192. So here's a split of their gross profit earned in 2022. Their financial year ends in February. So you can see that the big yellow part is after sales. So this is stuff like car repairs, servicing, that sort of thing. And that's very profitable. You can see in the table at the bottom, that's a 47% gross margin. Whereas the other parts of their business, selling new and used cars, are about sort of 8 to 10%. And then new fleet and commercial is 4.6%. I guess the businesses are pretty savvy about negotiating prices with Vertu. And then you can see their gross profit split. So it's about a third coming from used cars, a third from after sales, and the rest is new and Motability. Motability is cars for people who have disabilities, so they'll adapt the cars and sell those. So you can see the total revenue is about £3.6 billion, and that's before the Helston acquisition. After that, it's about £4.1 billion. And there's a 12% gross margin and about a 1% operating margin, but we'll get onto that. So here's some more information about the market and a comparison with some UK and US competitors. So looking at the left, you can see I've compared them to Lookers, which is I think the second biggest car retailer in the UK. Sytner is the biggest. They have about 6 billion sales, but they only have 5% of the market. So actually, the UK motor retail market is very fragmented. The biggest player is only 5%. So Vertu's strategy of rolling up acquisitions, they've got a long runway with that because there's a lot of smaller dealerships to buy. I've compared some figures here. So price to sales of Vertu is 0.05. Their gross margins, I'll talk about a bit more in the next slides. And then their price to book, when I recommended the share to my subscribers, was about 0.5. It's gone up to about 1 since they did the acquisition. And there's a very low coefficient of variation on the gross margin. So that means that their gross margins are very steady. Now you can see on the right-hand side the number of new car registrations. So if you're interested in investing in the UK motor industry, you should really have a look at the SMMT. That's the Society of Motor Manufacturers and Traders. They've got a lot of good statistics about the industry. So you can see that in 2020, there was a big drop in new car registrations. And that was because car manufacturers shut down their factories because of COVID. And the car dealerships shut down as well. Vertu was actually closed for 2 or 3 months. There's no sales or very few sales. And then it didn't pick back up again since then because there's also been a semiconductor shortage, which has affected many different industries. So that meant that manufacturers couldn't actually produce as many new cars as they had demand for. That in turn supported strong pricing in the new car market and strong pricing in the used car market as the stock of used and new cars went down. So although Vertu sold less units, they were actually more profitable. After making less profit in 2020 because of the shutdown, they made a really good profits in 2021 and 2022. Sort of super normal profits, I would say. And actually, that's still going on. And if you add up all the cars that weren't sold, otherwise might have been, it's about 5 million units. So one of their competitors, Lookers, they have a 22,000 unit backlog of new car orders in the third quarter of 2022. So that's still playing out, and that'll help improve the earnings as we go along. So I want to talk about some of their online competition. You might have heard of Kazoo. Kazoo floated on the New York Stock Exchange at $11, and it's a very sad tale because they're now at 21 cents, and they're going to be delisted. So essentially, they floated when everybody was excited about buying stuff online during the pandemic, but it proved more difficult to get the scale that they wanted. So they're set up to sell about 200,000 units with all the people they have and the buildings and everything. But actually, they managed a lot less than that. So they've just announced a plan to cut £200 million of costs, which means closing a lot of their areas. They shut down the European operations. So I'm not sure if they will or will not survive as a business. Also, their gross profit per unit was about £226, compared to Vertu was about 1900. So they're spending a lot of money on advertising and other things, which is impacting their gross margins, leading them to a huge loss. In the first half of 2022, they lost about £200 million, 243 million. And they only have about 575 million of cash and inventory left. So I don't think they're going to be able to raise more money very easily. So they have a limited time to turn it around. Also, there's Carvana, if you've heard of that one as well. The shares, I think, crashed about 90% as a US online car retailer as well. So Vertu sells most of its cars in dealerships. They do sell online, but a small amount. So looking at the UK car market and the switch to electric cars, that's a big trend, obviously. So we see a dip at the start of here, which is the pandemic, but then forecast to pick back up again to just over 2 million units, or about 1.6 at the minute. And then there'll be a slight dip again as we switch into a lot of electric cars here, as some people are The laggards refuse to convert. And then by 2035, the government's saying we won't be able to sell internal combustion engine cars. So 100% of new car sales will be electric. But the average life of a car is 20 years. So you can see the right-hand graph is a UK car park. That means the total, all the cars on the road. So that's still going to be less than 50% electric by 2035. These figures, again, are from the SMMT. So, of course, in any investment, you have risks. So I thought I'd call out 4 risks that could affect investors in Vertu. Operating leverage. Their margins are about 1%, and they're very stable. But obviously, if their costs go up, there's a big effect on their margins. So another one is interest rate risk. So they've started borrowing a bit because of this acquisition, but they're trying to hedge their borrowing. They're going to hedge about half to 2/3 of it, and the revolving credit facility and their mortgage facility. So I think that in the amount of interest they'll have to pay, they've got a very strong balance sheet, so I don't view that as a high risk. Also, the move to online could have disrupted their business model. As we've seen, the online competitors are really suffering at the moment, the pure play online ones like Kazoo. And Vertu launched Click to Drive during the pandemic. So there's a sales team, a telesales team, and they will assist you to buy your car completely online. And they've sold a small number of cars through this. It's a small percentage, single-digit percentage of their total sales, but they are moving into this area and they're trying to digitalize their after sales as well. So they're doing well on that. And finally, most cars are sold through a franchise dealership model. So the manufacturer sells the car to the dealership, and the dealership then owns the vehicle. Manufacturer is done at that point. And then if the price goes up in the market, the dealer makes a profit. They're free to set whatever price they want. But BMW want to move to an agency model. In the agency model, BMW directly invoices the customer for the car, and the dealer makes a fixed percentage on the new car sales. It doesn't apply to used cars. So they're kind of toying with this different business model. And other car manufacturers may follow suit. But I got this interesting quote from the chairman of BMW. He said there's no direct sales without dealers. He doesn't know of any way you can forfeit dealers. All the connection today with the customer is with the dealer. It's very localized. And BMW said it would be suicide for BMW to try and sell all the cars themselves. They need the dealership to sell their products. So dealers are here to stay, I think, even with this new agency model. It's yet to be seen whether this will take off in the market or not. So I'd like to talk about earnings quality and durability. So the top left graph is the gross margin of Vertu from 2008 to 2022. Very stable, around 11% or so. The bottom left is their operating margin over the same time period. So as they've grown, it gradually improved as they got economies of scale. It took a dip around the pandemic because of all the shutdowns, and then a spike afterwards because of the higher power prices. I've also calculated owner earnings, which is a measure that Warren Buffett likes. So that is their net income plus depreciation and amortization, including the leases amortization, plus the change in working capital, and take away the lease payments, capex, and provisions. So that's kind of a measure of if you owned the business privately, how much cash you'd be able to take out of it. So that bounces around a bit. It's the blue line there. And then the orange one is their reported earnings. But the reported earnings are fairly similar to the net earnings. So the earnings quality, I think, is fairly good. And in terms of Vertu's capital allocation, their strategy is to roll up the car dealership industry. So they spent a lot of money on acquisitions. They take their free cash flow and they buy car dealerships. So they're now the 3rd largest car dealer in the UK after the recent acquisition. They've also put a bit of it into dividends, and buybacks is negative because they issued some shares a while ago to raise money for further acquisitions, but they also are currently doing a buyback program, so that's coming more positive. So the management. So here's the boss, Robert Forrester. So he's been the CEO since 2006, since founding, essentially. Now, I actually, as part of my research for this, I also managed to watch an episode of Undercover Boss. I don't know if you've seen that program. So if you want to see Robert Forrester in a very dodgy disguise, um, with very dodgy hair and a beard, then you can watch that program. I think he came off fairly well in it, actually. Uh, so it was interesting hearing people talk about him, and he's actually never sold a car, which is quite interesting as well. It was quite funny watching him to try to do that. He owns about 2% of Vertu, and he's the kind of driving force behind it. So he's a trained accountant and he's very data driven. One of the things that we saw in my research was that they have a dashboard at Company HQ in Newcastle, and they have metrics of all the different dealerships and how much revenue they're doing and everything. So that they're tracking all the metrics very much. They've got a very good eye on that in the business. I think he sets high expectations of his staff and acts with integrity. So I also did a bit of scuttlebutt. I asked some of my friends, have you ever bought a car from Vertu Motors? And one guy said to me, oh yeah, I went along to Vertu Motors and Bristol Street Motors, one of their other brands, and I saw this really good deal. So I said, I'd like to buy this car. And then the person selling it to me was like, oh, I'm not sure, because actually I think they'd mispriced it. They put it lower than it should have been. So anyway, he insisted to buy it, and they called the management, and the management said, you gave the price to the customer, you have to sell it to the customer. So I don't know what happened afterwards with that person who sold the car, but Vertu honored its commitment to sell at that price. So I thought which was good. So they put the customer first. Okay. Uh, okay. All right. Okay. All right. So I like to look at ESG. So personally, I don't invest in certain stocks. I don't invest in fossil fuels. I don't invest in arms companies, tobacco and alcohol. That's my personal kind of ethical position. And I also like to look at ESG whenever I consider investing in something. So environment, obviously Vertu is supporting the switch to electric vehicles, and they sold their battery electric vehicle sales are up 169% 2022, ahead of the UK increase of 122%. So they're certainly taking their share of that market. And then they track the energy use across their dealerships and CO2, and they're trying to reduce their energy use across the dealerships. In terms of social, they have a corporate charity fund. They've got a very high employee satisfaction rating versus one of their main competitors, Lookers, get a better employee satisfaction rating. And also I read on Glassdoor, looking at the reviews there, that they supported their staff very well through the pandemic, that people who are on commission, who couldn't sell as many cars, they gave them a minimum salary, a guaranteed minimum, so they wouldn't lose out too much during the pandemic. Employee retention is an issue in this industry. I think you need to treat your staff well to make sure you retain your employees. I think they do that. Their auditor is PwC since 2006. If you're on AIM, you don't have to change your auditor every 10 years. So they have the same auditor since founding. But I looked at the Financial Reporting Council who checked their 2021 audit, and they said they find no significant issues. And the CFO and one of the senior independent directors are former Arthur Andersen partners, so they're very experienced in finance themselves. So finally, the appraisal. So I found two ways to value a Vertu. One is a net tangible book. So I did some calculations and figured out the net tangible book, excluding Helston acquisition, is about £228 million, and including is about £200 million. So right now the net tangible book is about 200 million, which is also their market cap at the moment. Yesterday the share price was 57 pence, making it 200 million. So if you value them on a price to earnings ratio, it's 5.3 times at the moment. However, I might expect that earnings to decline slightly because this was a bumper year because of the supply constraints in the industry, but still pretty low. And then another way to look at it is free cash flow plus growth. So I've calculated their owner earnings at a median of 29 million from the period 2015 to 2022. The average EBITDA of Helston was about 11 million, I've assumed that after tax being about 8.5, and add that on, it gets about 37.5 million net earnings. So that would be a free cash flow yield of 19%. And if you assume zero growth, that gives you your 19% return, which is pretty good. So in the 10 years, they've grown their sales at a compound annual growth rate of 14% through organic growth and acquisition. So that's it. And I'd like to invite any questions about the company or analysis.
Questions now, and then at the end we can, and depending on your time later, right?
Yeah.
Then we can take more at the end.
Okay, sure.
One questions now, and then we can take more at the end. Okay.
Okay, I'll come to everybody. Anybody asks a question, you can hear it online as well. Yeah. That's it. Any questions? All right. Josh.
Thanks. I suppose this is more of just a general accounting question, but obviously you mentioned that the average operating margin has been about 1%, or at least that's where it stands now. So where is the difference between that and the free cash flow yield of 19%?
Yeah, so their sales are about £4 billion. So an average operating margin of 1%, that would be about 40 million, which is pretty similar to what I've calculated for the earnings there. Yeah. Does that answer your question? Yeah.
Question, which is more fundamental. So they seem to be acquiring a lot of dealerships. So why are those guys selling? And why to Vertu?
Okay, that's a great question. So actually, Helston is an interesting case in point. It was run by a guy called, I think it was Simon Carr, appropriately enough. And unfortunately, he died and his wife died. And after they died, the business was put up for sale. And it was split into three portions and then sold off. So that was what prompted that particular sale. Individual owners died. I guess some of them are like smaller. It's very fragmented, smaller family-run businesses. People want to retire, cash out, so that gives opportunities to buy that way. So I guess I don't know all the other reasons people would sell, but there's some anyway.
Hi, just a quick question. How much property do they own? And any potential for them to sell any of their sites and move somewhere cheaper?
I don't think they'll be selling their sites and moving somewhere cheaper because the manufacturers require them to put capex into, making a really nice property for people to come to. So they've invested a lot in those properties, but they do own a lot of freehold property. So I think they have Helston acquisition, for example. They bought £67 million worth of freehold property through that, and I think they've got 150, 200 million pounds of other freehold property. So I think the 200 million of their market cap is probably mostly represented by freehold property, and then you add on their net current assets and take off their liabilities, coming back to about the same figure. So there's a lot of freehold property there. Yeah.
Yeah, let's get it. We have what, 2-3 minutes, so let's get one more.
What's their competitive advantage against all these other people you showed? Lookers and
Yep, that's a great question. I guess in the motor retail industry, you can go to different places and buy your car. So it'll be brand recognition and customer service, I guess. I'm not exactly sure why, they are what their competitive advantage is. I do know that Vertu had a better staff rating. The staff were happier according to their internal surveys. And I guess with their brand messaging, they would say they're built on integrity and trust. So they seem to have very good ratings for people buying used cars, that they treat people fairly. So I guess that I don't know about their competitors, how that compares, but they place a big emphasis on that.
So it says that the company has a market cap of 200 million. So I have two questions. One would be, how much do you reckon the true value of the company is based on your calculations? And second, do you identify any catalyst that would sort of make that value become a reality in the midterm or ideally near future?
That's a good question. It's hard to put like a precise value on them. I guess you could maybe put a value on them by saying, well, if you can get 19% return on this, and the standard market returns 10%, then you could calculate a value based on that. So I'm not exactly sure why they're valued, less than other businesses in the market. Because if the average price to earnings is 15 and the average return is 10%, then I think they're doing more than that. But yeah, that's the way you could value them, I would say.
If people want to ask something more, because we have 1 minute, we can have one more. We can go to the next one. Do you have any other questions, or do you want us to go to the next one, and then we can come back and discuss about more, like free to ask whatever question. Well, like if you have something else to ask, if somebody wants to ask something, we can ask. Otherwise, we can go to the next speaker.
In terms of catalysts, I guess the only catalyst that I could foresee at the moment would be somebody else buying them potentially. So in the US, I didn't talk about this much, but our dealers in the US are valued more highly than in the UK. And they tend to buy back shares more, they tend to have more debt. So the one that I looked at in the table a while ago, Sonic, they're much more highly valued. So there could be like a buyout of it. But I don't know of any other catalysts. Can't think of anything else at the moment, I'm afraid.
Are their earnings correlated with car prices? Because I know, for example, Hertz in the US is almost perfectly correlated to used car prices.
Yeah, so I guess Vertu are making the spread on what they buy the cars for and what they sell them for. So if used car prices spike up, the value of their inventory will go up, so they'll get a temporary boost from that. And they did have a record year recently when used car prices went up a lot. There was a shortage of supply, and the prices went up, and then they made a lot of money, sort of supernormal profits on that. So they are correlated to used car prices, yeah.
I guess kind of the reverse of that being with the normalization of used cars prices, what do we think in the short term?
I think that that's still playing out. So for the next 6 months, year, it's difficult to predict, but I think you'll still see that. There is that lack of new cars in the market. That 5 million units of new cars which would have been sold, but weren't because of manufacturer shortages. So that reduces the amount of used cars available in the market, and I think that could support the used car prices in the short to medium term. But I'm not the expert to forecast used car prices, unfortunately.
Thank you so much. Thank you. And now let's welcome Sak.
Sorry, second. I'm now giving you the microphone and everything. Okay.
So you can hold it. You have it. So we welcome Sak, who uses an automated strategy, and it's something that I'm so interested to follow, because I used to do something like that. I worked as an analyst and for a newsletter that we were doing this thing. So I will listen to you with much attention, which is a very interesting. We called it mechanical. You call it automated. So the microphone is yours. You can put that somewhere. Yeah, like that. And you are ready. The stage is yours.
Okay. You guys hear me okay? Yeah. And I don't know how this works. Is it left and right to use it? Let's see. Oh, here we go. Cool. All right. Hello, everyone. I'm a little bit nervous about doing this because this is actually the first time in my life I've ever done a PowerPoint presentation. So I'm nervous for that reason. I'm nervous for that reason. I'm also nervous because I think this is going to be a little bit controversial and you guys might actually kick me out of the room because it is going to be, I'm a contrarian's contrarian. I've been doing this for 7 years, full time. That means I don't have any other job. I am fully invested in stocks and cash. I don't have property or any side income. I have a little bit of royalties coming in from music from my previous career in TV. But this is all I do. And I think the most important thing you guys want to see, and I think you should see, because if you're going to come and talk, if I'm going to come and talk to you, then it's important that I have performance to show you. So this is my performance to end of 2022 versus FTSE 100, FTSE 250 and the all share. My personal benchmark that I use is FTSE 250 because I think it's closer to value styles. I don't do any AIM stocks and I think large cap tends not to get in there. But what is interesting about this is the variability. You can see mine's quite variable. But if you take it back a year and look at the end of 2021, my performance is a lot higher than it is now, just as the FTSE 250 was as well. And that variability, part of that's my fault, I think. I'll talk about that a bit later, but I kind of broke away from one of my rules, and I got overinvested in a few stocks. And one of those stocks was a company called Ferexpo, who are, yes, people are smiling. Yeah, they are an iron ore miner, one of the largest. I think they're the third largest iron ore miner in the world, and they need to get their iron ore out from their factory down a river, and it's the Dnipro River, and that, of course, is in Ukraine. So hence that result there. That includes all dividends in both cases. So that's my return so far. So I'm going to talk about how I came to this idea of being a quant, what I call a quant value investor rather than a stock picker. I was doing okay stock picking before. I've had some reasonable success. But it was reading about Ben Graham's ideas towards the end of his life when he came to the conclusion that it was actually better, it wasn't actually as profitable to do that kind of deep analysis, which we all love doing. And he moved away from that idea, did some research and decided that if you follow a particular strategy, and he back tested this over 50 years, he found that he could get an average return of 15% over any 5-year period. And I found that fascinating. So I looked into this, and I'll talk about that later. But other ideas that came to me, I'm sure a lot of us read around the subject of just reading annual reports and stuff. These were key books and key ideas that came to me. Fooled by Randomness. Taleb's idea that luck is such a massive factor in all of our lives, and we don't recognize how much of a factor it is. I think it's a big factor in investing. I wish it wasn't so much, but that was key. Another idea, thinking in bets. Annie Duke, she's a former pro poker player, and talks very interesting way about how all of life is a series of probabilities. And anyone who's heard Buffett speak knows that he thinks in this way. They talk about probabilities rather than profitability a lot. So that was key. Thinking Fast and Slow and the Psychology of Human Misjudgment. Great essay by Charlie Munger. If you haven't read it, I recommend you go and read this. It's online. You can get a PDF. Just the idea about how much of we are affected by our own biases, and we don't realize them. And I think I'm more affected by this than others, but that's because I have one bias, which is that I have a tendency for high self-regard. So I think I'm worse at this than everyone else. Misbehavior of markets, if you haven't heard of it, talks about how market variations scale. And they scale not just on a daily, weekly, monthly level, but it goes beyond that. Fascinating books to read. Ken Fisher, again, about our memories, our short-term memories. Our emotional memory is one thing I think we need to be aware of as well. We're all about our facts and this and that, but now with COVID, we can all think back to that time of how we felt about markets, how we felt about the fear of going outdoors, hanging around with people, fear of infecting elderly relatives. This was a massive fear in our lives. And it was only a couple of years ago. And now we're onto something different. There's always something different for us to worry about. But that short-term memory of fear is something that we can take advantage of in the markets. And that's if you're a stock picker as well. It applies in the same way. David Dreman, I'm going to come to that later as well. And these two Ben Graham pieces about his style of investing too. Why I do it? So I want to keep things simple. I don't think things should be any more complicated than they are. Get rid of your own biases. The decision-making process, I'm sure we've all found when you come to sell a stock, that's the hardest time. Buying it is relatively easy. When you sell it, it's like, well, if I sell it now, is it going to go up or is it going to go down? Invariably for me, stocks always go up after I sell them. It's something I've found. I don't know why that is, but it always happens. And that is the worst feeling that I was wrong. I mean, the decision, sure, I'm going to say, yeah, my decision-making process is fine, but leaving that kind of money on the table is not easy to do. So this, having an automated system, gets rid of that. It's proven to work. I believe it's proven to work, and I've back tested as well. And I think it always will work because human nature is just always going to be the same. Hundreds of thousands of years of evolution, you know, that fear and greed, what we were talking about before, what Demetrius put up, that quote about whether we should be fearful or greedy. We are descended from fearful people. We're descended from the people who, when they saw the rustling bushes and wondered whether or not there was a lion out there, they were the ones who ran away. When the markets tank, we have a natural tendency to run away. Now, we will try and fight that and say, no, well, let me think about the markets and see, are they really as bad? Should I really be getting invested? But the guys in our past who looked at the bushes and went, maybe it's not a lion, it could be something else, they're the ones who did survive. So their genes haven't passed on to us. So we've got a natural propensity for that, and doing things in an automated way stops us becoming prone to that. Now, there was a 2013 paper, this is going to be the controversial bit, so bear with me. A paper was written about Buffett's alpha, in which these three guys found that Buffett was basically his returns, he was buying stocks that were safe, cheap, and high quality, even though he was doing a lot of, you know, stock picking, reading around stuff. All of these, they're numerical metrics, and you could have done this without having any need for all that extra stuff. This is the point I'm making. Charlie Munger talking about discounted cash flows. I think the minute we get into DCFs and we start looking forward and making projections, they're estimates. So it's like crystal balls. We can say we believe in them, they're accurate, but there's a risk involved in that. And using numerical metrics like this, you don't get sucked into that. So they found in this paper that accounting for the general tendency of high quality, safe and cheap stocks to outperform can explain much of Buffett's performance, and controlling for these factors makes Buffett's alpha statistically insignificant. Now, that's a big claim to make. I'm saying that Buffett hasn't really got an edge. All he did was find some things that were cheap and bought those. But I think the key thing here is the second thing that they said, that he managed to stick to his principles and continue operating at high risk, even after experiencing some ups and downs. Everyone who's in this business knows that career risk is a massive thing. In fact, even amongst quants, it's a big thing. Apparently, during the GFC, 80% of quant funds pulled the plug on their strategies because of fear around what was happening in the market. They couldn't handle it. The guys behind that didn't have the bottle to say, I'm going to keep this going, I'm going to get there, because they knew their careers were at risk, their families, their income, that was at risk. And that fear that everyone had at that time, it just permeated through. So if there was any way for them to pull the plug, they did it. So he had an emotional advantage, I believe, not a stock picking advantage. If you want to read that, there's the link there. I think it's a great paper. So this is the conclusion I came to, and Charlie's helped me. That there's no way that on average, maybe you guys, but I don't believe that I could get an edge stock picking, even if I've had some results, and they could have been down to luck, over a period of time. So what my strategy does is I get rid of the sell decision. I have a fixed holding period. It's either 1 or 2 years, depending on the strategy. And what I do, I think, is uniquely different for a lot of these strategies, is I use pound cost averaging to average in. Now, a lot of the time, these strategies are based on one fixed point in time, or when a pot of money comes in, they'll do that. But pound cost averaging, dollar cost averaging, putting money in slowly gets rid of those gyrations that we talked about before, Mandelbrot was talking about. And I rotate after 1 or 2 years. But the beauty of these strategies is you move more to cash as fewer stocks show up, and you move more into stocks as more stocks show up as things get cheaper. And I must say, October last year on my strategies was the cheapest it's been in the last 20 years. Now, I don't know whether it can get cheaper, but it literally has been the cheapest.
So it will show like screeners that you run show like more and more companies when it becomes the
yes, that's what happens.
The screen has 10 companies if it's very strict, then you see, I don't know, 20, you see more. So it's another way to see it.
That's exactly right. That's how it works. Now, some of the screens, they do alter with time based on rates, but generally that doesn't happen, and it means you have a natural pull back and forth. You don't have to worry about, we don't have to have this discussion. Is the market up or down? Is it going to go lower or not? Is it cheap or not? Everyone's got the opinion about that, but we don't have to do this if we're automated. Okay, so Graham's last will, a simple way. I don't know if any of you guys have heard of this. Have you guys come across this at all? No? Yeah. You have? Okay, great. So in 1976, he did some research and found that if you invested based on these 10 metrics, you could get a performance of around 15% a year in any 5-year period. And he back tested it over 50 years. And he said that anyone could do this if you just followed that. And he had a 2 to 3 year holding period for these stocks when they appreciated by 50%. Now, I found that a bit wishy-washy. Is it 2 years or is it 3? If you buy and then hold, and then after 2 years the market tanks, but you're invested in these stocks, should you sell them or not and buy cheaper stuff? He wasn't clear about that. And saying things appreciated by 50%, well, I tried this out myself. What happened was things appreciated by 50%, and then I sold them, and then they went up by another 50, 100%. because they were cheap, and I didn't like that. So I decided that I was going to go for a fixed holding period, and the fixed holding period I decided on was 1 year. And I back tested this. I used Sherlock Holmes. I don't know if anyone uses that. They have data going back to 2002. I back tested it, and I found it worked best over a year. And I think certain stocks with certain metrics, people forget about after a year, or they become more comfortable after a year, and they start to buy in again for whatever reasons. Yes, please do. Yeah. No, I haven't actually. Really? Okay, I'll look into that. I like the fact that Sherlock Holmes, you can put in your value metrics. Have a look at it. It's very cheap, 70 quid a year. You can put in your value metrics. You can, pick whatever you want, and it will test that and show you the performance had you bought those stocks in any quarter going back over the last 20 years now. So you can find that interview that he did for medical economics at that time. So these are two of the screens that I run with this. So I rotate them once a year. That's the result I found, an annualized performance of 31% for the first one, with a tight PE ratio less than or equal to 8 times. Now, Graham actually said you should vary this depending on the bond yield. I keep it fixed, and in that way, more or less comes into the funnel. So the fewer stocks come in, excuse my formatting, there you go, first time using this. So I expanded it a bit more, and I get more stocks here coming in if I expand that out a little bit. I actually have a dividend cover I put in there, which he didn't actually include, but if you read security analysis, it's a major part of that. It's very important that we do have companies that can cover dividends. And I found that those companies that weren't just throwing money back because they could afford to throw money, not afford to throw money back, rather they couldn't reinvest at good rates, were often giving back money. And if you have a nice coverage, then you know that there's some retained earnings there that are also going to give you value. And I think it shows good management sense as well. So that's what I did with those. Another screen I run is based on David. Yes. Yeah. Yeah. So sorry, the question was, do I only look at stocks that pay dividend? Yes. And the dividend yield has to be 2/3 of the current AAA bond yield. So if it isn't, then they don't come up in the screen. And I'm not, what? If they're not no, the question is if they're not paying a dividend, no, they don't come up on the screen. I think dividends are crucial. Dividends account for something like, I believe, maybe someone correct me if I'm wrong, but around 40% of long-term returns are actually dividends. Is that wrong?
That means that the bond yield is not very high.
It means that the
bond yield must be very high.
What?
If you 2/3 is the cover
of the bond yield, yeah.
That means that the bond yield must be there.
Bond yield at the moment.
But not risky company.
Well, it's the AAA bond yield for corporate. So it's about 5.4% right now. So 2/3 of that, whatever that is, 3.8, something like that. That's what you're looking at. You're looking at a yield of more than that. Sorry, have I got that the wrong way around? I've got it the other way around. I have, haven't I? I apologize. It should be the other way around. It should be more than, yes. My apologies. Well picked up. So yeah, you should have a bond yield that's at least that, at least 2/3, yes, of the current AAA bond yield. Excuse me for that. Let me check everything else. Everything's right. Yes. So take out the market cap, smaller market cap companies as well. So David Drummond's research, if you've read the book Contrary Investment Strategies, great book. When he did his research, none of the academics would accept it because it went against efficient market hypothesis, and he was pilloried at that time. So
Fired or analysts should be fired or professionals. Something works.
Yeah, that's right. Yeah, they would be fired. So he found that low price, these basic low things, basic low price to cash flow, low price to book value, low price to earnings, and a high dividend yield would outperform. And he claimed that having just buying on those low metrics, I mean, it's obvious for all of us, right? That's what he said. So he also said 2.5 years to 3-year holding period. For his screens, I hold for 2 years. I've tested and they seem to be better. I've got the dividends the right way around here. Right, so I found that a screen that I used to call the Dremen sevens, 7 times, less than 7 times PE, book value and cash flow, not free cash flow, works really well. Very simple. A dividend yield, I throw out the high dividend yields. Sometimes stocks get to a point where they've been trashed so much that that dividend yield is still showing as really high. And you know it's going to, if that happens, you know that they're going to cut that dividend or the company's in trouble. If it's throwing out a quarter of its market cap as a dividend, there's something wrong there. Really is. So that's it. That's a very simple screen there. How am I doing for time? All right. A third one, Piotrowski. Anyone guys know this from your academic? From anyone looked at? Joseph Piotrowski wrote a paper 2002 and gave companies scores. You could have a maximum of 9, and you got a point for each of these. Can you guys read them? Are they big enough? Yeah. Okay, so they were basically profitability, the first 4. The next ones are leverage and liquidity. And the last are efficiency. So you're looking at higher gross margin compared to the previous year and a higher asset turnover. That's basically compared to revenue compared to the previous year. So there's a movement on the upside. And if you actually get stocks which are high on these factors, they can do really well. What I've done is I added in the PE ratio and I added in tangible book value quite tight, and a yield as well, just to make things interesting. And I found that certain times you get quite a few come up, but it does perform really well. And that performance is per year. So that's an annualized performance of 25%. And then I have a couple of value screens that I run, basic value, high yield ROE, and low price to book. Again, tangibles. Nowadays, I think intangibles are kind of more important than they were in the past, so we can't ignore them completely. People are making software. It's not like it was in the old days where intangibles were just like goodwill. You paid out extra for something maybe you shouldn't have bought as expensively as you did. And that's it. And I run those screens as well. And this is how I allocate. Basically, how I allocate, I go in. So for the Graham screens, it's every year. So you take the amount of your portfolio you want to put in. In my case, I allocate 1/3 there, and the other 5 get 2/3. And I just cut it into 12 pieces, and I invest and I rotate, and that's it. Very simple. And it takes out all the guesswork, and it's been working for me so far.
So also you adjust, because as you said,
Moving closer to you for the question.
you automatically adjust, right? So automatically if something goes down, if a strategy, because that's very wide, so you use different strategy, you adjust. So keep always the percentage stable. You always buy the cheapest method, and that way you get an extra from there.
That's right. That's right. Buying the cheapest method and also having a number of different strategies. Like if you have one, then there are times when nothing's going to come up or lots is going to come up, and there might be times when it doesn't work. And I know the argument is, well, if it did work, then everyone in the market's going to find this strategy, and they're all going to go, oh, we're all going to do that Graham simple way thing. But that doesn't happen in reality. The major funds are not going to do that. And that's the edge that I have, and that's the edge that you guys have, even if you're stock picking, that they're not going to be able to do that every time. But that is key, and I found that different stocks come up. What is interesting is when lots of stocks come up that are the same in all these screens, you know it's kind of a screaming buy. And that's a good time to be thinking. But I'm not saying I do this completely automatically. I do read earnings calls, transcripts. I do read 10Ks, and I do make sure there's nothing going on with the company. Things I don't, when I don't invest in the stock, if there's fraud or if there's substantial legal cases, because they don't come up on these. They don't show up. If there's been large share issuance, if they're pretty free with their treatment of shareholders, and if there's been, that's it, basically, those two. I can't think of any other reason why I would. So to close, I would just like to give you these two. This works for me. It works really well for me. I want to have more time to spend with my family, go out and do other things. But I must qualify and say that I do have a little bit of money that isn't invested in this way on the side that I do stock pick with, because it's funny, fun. And it soothes my urge to be involved and to feel like I can actually do something. And it keeps me interested in the markets because I can't get away from it completely. The other advantage I find of doing an automated strategy and putting money in over the course of many months is I get to look at the markets every day. I feed my gambling habit. So I look at these stocks going up and down and go, oh, maybe I should split it into 3 this month and I'll buy 3 times, and I put it in over the course of whenever I see things varying. It doesn't really make that much of a difference. When you've had a stock go up 150%, 200% after a couple of years, you don't really care whether you paid 1% or 2% more, at the beginning. But at the time, it really feels important. So I know my own biases, and that's what I do. I kind of get around them in that way. So that's me, and that's how I invest. And hopefully I'll convince some of you guys to give up this stock picking malarkey and join me on the other side. Okay, that's it. Thanks very much for listening. I can do it. Yeah, I don't mind. I can take a walk and hear everything.
Lovely. Thank you. I was just curious, obviously you must have a lot of turnover in your portfolio. How do you sort of balance that with the frictional cost of sort of being in and out of the market? And do you have any concerns that you maybe are missing out on sort of the compound returns that we often hear about?
How do you mean the compound returns?
In terms of you sort of investing.
Oh, yes. Well, investing for the long term does compound, obviously. But if you're getting those returns every year, then that kind of gets nullified, I think. Frictional costs, my first page, those returns were including all those costs. The only costs you are going to get are tax. And that depends on how you allocate that, whether or not you're happy doing that. I think Munger has always said tax is one of the worst things that you can have happen to you. So if you've got that much money where it's going to affect you, sure, by all means, buy something and hold long if you think that's going to give you better returns. But I found even working out what the tax implication is going to be, you've got to sell them at some point. And that tax is going to be there if you want to start pulling that money out. And I do also live on this. So, yeah, I need to do that. But it works out fine for me. Yeah, this way. Another question.
A couple of very quick questions. One, do you do any adjustments to earnings or book value in terms of you look at the 10K and say, well, the company has changed their accounting system and are gonna adjust, of course, the earnings or book value, etc. And two, what is your database for the hardcore data that you get the sort of ratios that you use?
Okay, so the questions are whether I make any adjustments. I don't make any adjustments. I use Sherlock Holmes, and their data is pretty good, I think. I use that to backtest. I use it for the screens as well, and the screens run. And I've tested them. I've looked again at annual reports and make sure that the figures are right. I can't see advantage of adjusting for. I mean, yes, okay. So if making adjustments for book value could potentially increase returns. I don't know. I think it'd be very difficult to work out because then you'd need to adjust certain companies for book value and then test based on if you had or hadn't and do a comparison side by side. I think the point for me is it's got to be simple. And if I get too involved in it and too involved in all the accounting stuff, then it's taking time, which I don't want to spend. I've got about 40 plus stocks at the moment. Reading all the 10Ks and earnings reports for all those stocks takes a lot of time anyway. So I wouldn't have the time. I don't know if it'd make that much of a difference. Maybe I should check. Maybe I'm missing out. You might be right. So, 2 more questions. Yeah.
Thanks for your talk. So over what period did you do your back testing? Which years did you do it for? And also, how long have you been using these strategies? And the reason I'm asking is because I want to know as well about survivorship bias. And is the Sherlock Holmes database take account of that?
Very good question, actually. Survivorship bias, yeah, they do get left in the screens. I think the problems are when they go to 0. That's a problem. It doesn't show up correctly, but I have adjusted for those, and it works. So, good question. What was your other question? It was about how long have I been doing this? For 7 years. The back test went back to 2002, which is when their data goes back to. And remember, I am back testing my extra bits on top of work that other people have done, like Ben Graham. And if you actually, other people, I'm sure you might have done it as well in the past. Broken Leg have done it before. So, they've back tested these as well for a while. So.
I have done with portfolio 1, 2, 3, like a lot of analysis on that. And what I have found as the most tricky part is that when a method works fine for a few years, it's because like you have an area, let's say you had like 10 different methods. When these things works fine, for that period that it works fine, when you go back, it goes and let's say makes up the numbers for the 30 years, for the 20 years. So at that point, the worst time to buy every of those strategies, they show up a bit better than they are at their worst time, and at their better time because the last but the last 5 years, if they are bad, they change the 20-year back test, and that in their best time they show them that they deliver less than they can, and you can see it historically. So if you account for this cyclicality, the solution that I just felt, and sorry for the is by checking this thing, by checking like you do a certain screen and it's strict and 10 companies show up. When you have 3 showing up, probably it's not the best time for this strategy. So for this specific strategy, what I used to do is tracking how the number of available stocks, and if I show a strategy that works very well, but the available companies are becoming less and less, I was less optimistic than the actual data would say. So that was something that I was thinking for myself. And yeah, yeah.
That's interesting because when fewer stocks become available, there are other screens there. And if there's nothing, well, it's never been the case that nothing's come up for me. But if there are fewer coming up, I just invest less. That's it. And it works. The other thing I do is I take, for Sherlock Holmes data, I'll take each of they actually give you each quarter's data. And I took that, and what I did was I rotated it through. So assuming that I was buying during the 4 quarters, and then I took an average of that to get my results so far. They might be wrong, but I don't think they're going to be that far wrong in that way. So that was the 2 questions you had. Did I answer everything for you? Yeah. Okay.
I think mine's related to the backtest question that he asked. I don't know if you have this offhand, but then do you remember how these strategies performed at like times of stress, like 2008, 2009, or times of high inflation? Just because I guess that's similar to the macro environment today, and so Because I guess if the last 7, 8 years of like if asset prices generally performed well, then if in case your strategies are correlated, just to see like how they did in times of stress when things weren't so rosy from a
That is a really good question. I'm very aware that over the last 2 decades, we have been in amazingly good markets. In terms of interest rates, it's been fantastic overall. If you think back when rates were a bit high for a while, 2006, 7, and then of course they tanked afterwards. The screens did really well actually during those times. So that's what I'm looking for. I look back over that period and go, wow, that was amazing. 08, 09 was amazing. Look what's there. And I use that row count of what the stocks are. And based on that, September, October was a really good time. And I probably didn't invest as much as I should have. But I think I made the mistake of thinking, well, it'll get worse because everyone's talking about how it's going to get worse, and we all agreed earlier on that, or some of us did, that maybe, there's still a lot more to flush out in markets, and if that's the case, then I go all in. I've got nothing left to spend. Well, so there is that element, but you're right. Yeah, it's been a good period, so I'm looking for those. But again, if it gets bad, I'll just come out to cash. I'm fine with that. I don't. I've been 50% cash before. In 2017, I was 50% cash, and 2018, I think was a really. Oh, have you got my performance page up? If you have, just for because that I think that. I think it would well. All right, let's see. Oh look. I've got to go all the way back up to the top. But that, you should see on that time, I was pleased. I was feeling like, why am I not putting any money in? But I did, there you go. 2018 was a down year for me, but it wasn't down as much as the FTSE 250, which is my tracked benchmark, because I'd gone to cash. And 50% cash was kind of saved me at that point in time. So I think having that leeway and that automated leeway and not fighting it, and that's what I've got to get better at, is just going with it again. I think I became complacent in 2021 with everything going up so well. I was like, yeah, this is great. It's all going to be fine. Obviously, I need to learn from that, and that's a mistake I've made.
So, you said the FTSE 250 is your benchmark. Is your universe of stocks UK only? And if so, can you comment on why?
Yeah. So my universe of stocks is, and this is an interesting question related to what you were saying earlier about investing internationally. I intend to retire here. I have invested internationally before, and I do on the stock picking side, but I think the big risk that we didn't talk about actually is FX. So if I invest and find that over the course of time, rates change. Let's look at what happened with Brexit. If I'd been a US investor going, oh, I can run these screens in the UK and it's all really cheap, fantastic. And then the pounds tanked by whatever it did, 30% from 150, 160 to virtual parity. I've lost out. But not only have I lost out on my investment, I've lost out on any gain. That drawdown is massive. So I don't want to be investing that way, but that's me personally. I mean, it applies very well internationally, doesn't it? These screens, but if you can find the data and run them, I think people are using. Huh? Sorry. Would it make money if you were invested in the US? If you were a US investor investing in the UK, yeah, I know the other way around is what I feel like. Yeah, no, the other way around is what I worry about. So.
Be a problem for those starts in some areas also.
Yes.
Like very high inflation can make fakey.
Yes. I mean, and also when you've got international companies, who are suffering from foreign exchange in terms of their earnings, what they're bringing back in because they're international companies, so that can affect them anyway. So it's an element. Have we got?
I have a kind of a serious question for you. So you've been running this for 7 years. Your back testing shows the strategies delivering 19%, 28% sort of CAGR. You are clearly not getting there, right? So have you thought about what's going wrong, and do you want to change your mind about it?
pragmatic. I think I need to give it more time. Oops, sorry. Thank you. I guess my early year, I was still working out these strategies. I was doing them, but it was less refined. I think maybe the cash holding I need to be careful of, and I need to be careful of my hubris where I'm pulling out. I think it would have been better, yeah. And if I was doing it right, I think that's been personally a mistake of my own, really. But you could be right. Yeah.
For that quantum screening, you were qualitatively deciding to not invest if there's a litigation.
Yes, yeah, as well. A little bit, yes, a little bit. Yeah, but maybe maybe that's a mistake as well. Might be right. So, yeah, maybe that's something I should do less of. What do you think? Well, if you guys were me, would you say don't do any of that? Yeah, absolutely.
Has talked about this extensively. Does it make sense adding a qualitative filter on top of quantitative screenings, right? And in his experience, if you are really going after, I mean, yes, I think he has published some books around it. The Acquirers Multiple and one before that. And he is basically saying that you should not be adding a qualitative filter because that's when you get really cheap stuff and that could add the alpha. I think that was his argument. So I was just wondering whether you've thought about that.
Right, and I think maybe this, and I thank you for that, and this is why these are great, doing things like this, because I come away with improvements. And I think you're right. I think I look at people like Jim O'Shaughnessy as well, Cliff Asness, these guys who are pure quants. They literally do not deviate at all from the strategy, and they never pull out. I think that's a good point. I think it might be fair for me to then stop. So, see, I would have, yeah. I see. In that case, the qualitative factors about Ukraine, the fact that there is a legal case going on with the owner of that as well, So,
that's the discussion that I want, and I want like everyone to participate. So now we will have a Q&A session. So you will be able to ask for this presentation, but also for the previous presentation, and also like for the first thing. So I can hold the microphone because and we can go around and you can because only me, I want to ask like 10 questions. I'm holding myself. And
the one thing is about this is, it should be a message for all of us.
yeah.
Feeling like, challenge me and tell me what I'm doing wrong, and I can think about, and I'm going to go away and think about all these things and think, because you guys are clever guys, you're intelligent guys, and this is what I need, to help me out, because it's going to stop me losing money. So thank you very much. And maybe if it does, and the things that come out of this, I will buy you all a beer and stuff after another 7 years. Yeah.
We really enjoyed it, and we will come back to questions. I just want to show you something that we said earlier. That's not the one. This is the one. Yeah.
Your translation.
Yeah. So, guys, this one, before we go to the Q&A session, I don't know if you received any emails or if you're aware about this thing that we have launched. Are you aware? Is anybody that has run this test? No. So basically, there are 20 questions, and also we give prizes. So I really recommend it to do it, because you might see your score, you might find out things that you didn't know. So it's a challenge. So you can go to this address, or if you see the emails that we send you through the meetup, you can go and do it, and it's for free. It's for free, and you can get prizes and learn something. And let's see who's gonna win. Okay. So after this, we can continue the Q&A session, and you can ask for whatever you want, for the presentations, or for the mechanical strategies, or for the things that we said earlier. So we can discuss anything you want. Like, yeah, just hold the two of these, and the microphone can go. Okay.
Thank you. I just had a question for Zim, if I could. Obviously, we touched on it earlier about the sort of acquirers multiple and magic, I think Greenblatt's magic formula. I'm just curious what the performance has been on a comparative basis with what you have created, really.
I find that Greenblatt's magic formula didn't do as well on what I tested, and yeah, yeah. So I didn't test for the acquirers multiple. I'd only tested for Greenblatt. Yeah, I mean that's the thing. That's why I think it's important. Like I mean that's short. Like 7 years is not a career for me. But that's all I can show. But if you haven't been making money for a long time, that's the thing. It's a reason to say it's not good. But I noticed with Greenblatt as well, the magic formula, it can take in a lot of stocks. And if you look at his portfolio, his filings, like he has so many stocks that he buys, and transaction costs would kill me on that kind of thing. Just that much trading, it's low anyway for me, but still to be doing that kind of volume when you're buying 0.6% of 6 basis points worth of your portfolio is going on a stock, and you're moving things around at that level, it's not really worth it. So I had to find a balance personally between where those trading costs would make an effect, and how much trade to do. Because I can automate with my broker. I can set up an automated regular monthly thing as well, and that helps a little bit. But it's that much involvement, I think, is a bit too much. But people like magic formula. Has anyone run the magic formula? Yeah, you've used it.
I've only just dabbled in it really, but I ran it for curiosity once or twice. Yeah.
Do you use it as a pre-screening technique, or do you actually just run the whole thing?
I've never actually bought a stock I found in the magic formula, but I tried it out. I was curious, so then I started looking at the financials of each company, and I didn't want to buy any of them. So
why didn't you want to buy any of them?
I just felt there's various. I like the sort of bottom-up stock picking approach, and there's some things about the red flags that I didn't like. So I didn't really use it in the way it was intended to be used, which is just buy mechanically, to be honest. So
but you used
kind of difficult to bring myself emotionally to buy something when I saw a red flag.
Hi guys, hi, hello. Yeah, there's people out there. It's like real people. Yeah, so that's interesting, because I think even if you guys don't want to use these screens, having the knowledge of those screens and maybe using them as a starting point for your own analysis, like you did, is a great way, because a lot of that work's kind of done for you in a certain way, and you know that there's an element of. The thing I find hard is giving people individual stock tips. People are like, oh, what are you buying at the moment? Well, I'll tell you one, but if you buy one or two of these companies and then it tanks, you didn't buy the other ones. And it's a whole system that you've got to incorporate. So I never give stock picks. I've mentioned this. There's Jim O'Shaughnessy does a podcast. I don't know if you guys know Infinite Loops. So he talked to Cliff Asness, and Cliff Asness had been on CNBC and talked about AMC, and made some comment about it because it was one of the stocks he was shorting, and they went after him like massively. People were like, "Oh, you're destroying my family, and we need this stock to go up," and he was like 0.6%. It was a short. It wasn't going to do anything, but if you talk about things in that way, the individual stocks doesn't work out. So that's why I have my side things going on. If anyone wants to talk about semiconductors, I can do that, because that's my own stock picks, and tech. That's my interest. So
have any of your screening stocks ever made it into your stock portfolio then?
the other way.
The other way. That's
No.
quant strategy, is it?
No.
Oh, that's done really well. I'm investing in that.
No, I haven't. What I do with my stock picking is stuff tends to be more overseas. So apart from Shell, I think, which was in there. But tends to be overseas stuff, and I'll do US because we all have. We talked about the S&P. It's one country that's different, I think, from all the reasons we gave for not having, for not investing overseas is the US, because the language barrier isn't there. Generally, the regulation is pretty similar to the UK, and there's so much talked about in the media. You can switch on any of the channels, and you will find information about the latest information about stocks that you might want to buy, and you don't get that for places like Turkey.
Do you think that's an advantage though, or a disadvantage? I mean, one of the things that I think about when buying stocks is overlooked stocks or stocks which aren't followed by analysts. If they're not featured in the news, maybe they're more likely to be mispriced. So sometimes, I'm never going to buy a large cap like Tesla or Facebook, but just because it's very difficult for me to see a way that I would have an edge on other investors who, so followed in the news. Like, how would I know something about it that they don't? So I would see that a lot of news flow and a lot of commentary and everything is maybe a disadvantage rather than an advantage when picking stocks.
Yeah, I agree. It can be. I think also, but I think having that in your line of sight can give you some insights. Like, you don't have to put in your diary when so and so is going to have an earnings release because it'll be out all over the news, and you might hear about something else, and you can hear about related companies within areas. But the one thing I was thinking about this, I don't know what you guys all feel. I agree with your point about if analyst coverage isn't there, I'm not sure that's necessarily an underfollowed stock. And the reason I have for this is there are so many people like us who are out there who are following stocks that just because an analyst doesn't cover it because it's not going to make any money for the big funds, it might be smaller, but there might be people like us who are ex-city people. Maybe they're in the 60s now and they're sitting at home and they've got time and they don't want to invest in the big stuff. And they're poring over these reports and they're skilled. And there's thousands and thousands of them everywhere. So I think looking at one analyst and going, oh, there's only two analysts covering that, or there's one, or there's none. Great, it must be mispriced. Isn't necessarily the case because there might be other people. So I don't know if anyone agrees or disagrees. I don't know if that's something you've thought about.
Yeah, I've got a more sort of quantitative measure of overlooked, I guess. So I look at the share turnover every year. And if it's less than 100% turnover, I would consider that maybe more overlooked. So the shares are not trading as much in the market. And sometimes, the stocks maybe 25% turnover, 30% turnover. So I would say that's more overlooked. Yeah.
So any other thoughts on that? Yeah.
There's just one quick one. I'd say, in terms of analyst coverage, you could say that that's a proxy for institutional investment. And when more institutions come into a company, that's when there's virtually no abnormal profits at all. So, yeah, I mean, it depends on how you look at it, really. Yeah.
So let me. I agree with you most of the times, but I think it also depends on stock to stock. So, I mean, to give a counter argument, which is quite famous, arguably Apple is one of the most followed stocks by institutional investors. Apple, and by research analysts. And Buffett went into that stock in 2016 and made 30% IRR over 5 years. So, and it was a public deal. So the argument that just because a stock has a lot of research analysts or doesn't have a lot of research analysts, I don't think it holds that much. There is some argument that if stock doesn't have analysts now, but could become bigger because the company is growing and that could act as a trigger event, yes, that argument definitely stacks. But other than that, I don't think there's much to see in there. That's my view.
But can I just say on the Apple side, full disclosure, I bought Apple after the iPod and before the iPhone. And then I sold Apple just before Buffett bought it. I was like, this is really expensive. I'm not holding this any longer. It's at 22 times earnings. This is ridiculously expensive. And I sold it. So my stock picking, if I give you a stock pick, don't follow it. If I tell you to sell, don't sell. So yeah, okay. Yeah, I'll tell you what I'm saying. So, yeah. So, any more on the car dealership side? I find it interesting. Lucas has come up on some of my screens, and I bought that recently, and actually a while ago. And I'm interested in that why you chose Vertu rather than Lucas, because some of their metrics look better actually, and they are a very well-known brand. So, is there any advantage that you see between the two?
Well, yeah, to be honest, it's been a little while since I did the initial analysis. It was in, I think it was last year, I bought it, so I don't remember fully, but I think looking at the stability of their earnings was one thing. I thought that Vertu had a more stable kind of pattern of earnings over time. I think Lucas was a bit more up and down, volatile in their earnings. So I'd like more stability of earnings because that gives more predictability um, uh, for the future. I think that was the main reason. I think Vertu was cheaper at the time as well. I think they were like lower price to tangible book than Liquors was at the time. Yeah.
So tangible book you're looking at, but tangible book includes inventory as well, isn't it? So it's how much of the inventory write-downs and write-ups as such affect that value generally? Because car prices, they've changed a lot, didn't they? So do you take that into account, or do you revalue and look at things and say, well, okay, now it's becoming more expensive, but you know the inventories are all. Is that that's right?
Well, when I looked at Vertu originally, they were priced at half tangible book. So I felt that they were 160 million pound market cap at the time, and the tangible book was, a lot more than that. So I guess, it, yeah, that includes the net current assets, which includes the cars that they own. So um, I just felt they're really cheap, to be honest. So it's like it's like what I think was it Charlie Munger said. You don't have to know precisely what a person weighs to know that they're fat. Um, so I felt that they were very cheap, and there's a good margin of safety there. Really, that's what I felt. So yeah.
So we've been focusing the questions on the fact that the company sells cars, but I believe from your presentation, a good chunk of their earnings actually come from the after sales service. Uh, I don't know exactly what that includes, if it includes repairs or not, but if it does, so I first of all, I believe that makes sense from what you said, of earnings being more stable than a company that just sells cars. And second, does the company have sort of a contract with the buyers that would assure that the buyers would come back to Vertu for the servicing after the sale, or it's open market? And I'm saying this because when it comes to, for example, lift companies, they don't make that much money when they install the lift, but they do a lot of their earnings as they service the lifts. So is this the case with Vertu?
So I guess when you buy a car, the only way that you have a contract to go back to the people is if either if they sell you an extended warranty, in which case you know it's like an insurance policy really for the car. So then they'll do the repairs, but they'll make the profit for that extended warranty. Um, but apart from that, you're not contractually obliged to go back to them. Um, I guess you're probably maybe more likely to go back to them, especially if you're buying a new car. Um, you've got a bit more money to spend then. So, but there's no sort of contractual thing that you would go back to them. So, but you do have a relationship with them because you purchased a car from them, and almost all the people who buy cars from Vertu go there in person to the dealership, and they shake somebody's hand and they go there in person. So they have an established relationship with the dealership, which makes them more likely to go back. Is there another part to your question? Okay.
So, Dimitri, this is for you. Can you pull out the slide which showed the global map yeah, yeah. So I was just curious. So that's measuring the sentiment for last 1 week or 1 year. Is that how it works?
Now there exists a screenshot.
So I'll tell you why I got curious. Um, so earlier this month, I was looking at which market did well last year. I think some of you may have come across, right? Which market delivered the best returns country? And the answer that came out was Turkey. So Turkey last year in dollar terms did 72% in dollar terms, right? Yeah, so I was just wondering, so like I get, and last year, if you would have run this analysis, I'm sure Turkey would have been like massive red because sentiment was negative because inflation is like 80%, 90%. So I'm just wondering, is that how you look at it? Like if you look at 1 week or 1 month, it will show what the market sentiment is. So this is basically saying China right now, market is very positive. Positive stories are coming out, yeah?
Just to explain that this sentiment, for example, it's calculated by the news, so it's the content. So that's the great thing about it. That it's calculated about, because maybe there are different ways, but yeah, it's calculated on the content that it's about. So it's always interesting to look about it, and I don't know if now that we have all those data, and it's possible with technology and artificial intelligence to retrieve all those things. Maybe we can also add those automated things in screen, so maybe people can use those data and do things that probably are not, because the problem always with mechanic or automatic is that if somebody can do it, then more people can do it, and then it dies out. Okay, there are psychological reasons why people cannot do it, but sometimes there are technological or limitations. So what you're mentioning is interesting. Yeah.
Myself because O'Brien throughout last year was talking about Turkey, right? And I came across a few times but never looked into it. And yeah, I was really upset saying I could have all you could have done is just bought the main index, which you can buy ETF
But
for Turkey without going into individual stocks. And that market has done 70% in dollars.
in dollars.
1 year return 72% in dollars. Turkey market. Something which Pabrai was screaming, saying, I'm telling all my friends, go and buy Turkey, go and buy Turkey. Entire last year. I don't know. I don't know. I haven't looked at his recent podcast, but actually he's yeah. Yeah, no, I thought he's still saying Turkey is still an exciting market because inflation is still high and things are quite cheap. But I was just wondering, like, maybe this map can be used as a contra indicator. Like, if something is flashing red, maybe something is super cheap there, right?
Yeah, I totally agree. And there are many ways that somebody can use those things, and also you can see that by sector. You can filter things, and when then you have languages added, then you can do a lot of things, and those are things that we are building in CityFALCON. Yeah.
To say this, it's kind of like a global fear and greed index, isn't it? Really, that's basically it. You want to know where people aren't feeling good about their country or the market in that place, and you go and invest there. And that's, as I was saying, fear. Your emotions are the most important thing. I always tell people who are not in finance or not related to investing that the numbers are only 5% of it. 95% of it is emotions, everyone else's and your own. And this is just a classic example of how you could potentially use that. And I think what would be interesting is looking at it over a period and how that period's can you do these as charts? So you can do them as charts as well. Because if you could see how sentiment is changing or has changed.
For a specific company, for example, let's say we go
for a sentiment. That's the thing. So sentiment of a country, you can see whether that's changed and look at how it's, because I mean, how do we feel about the US? Sentiment in the US is what? Is good, bad? Could it get worse? Is it gonna get worse? Not getting worse, okay. Getting worse. So you think
Sentiment is very positive last 1 week. The US, 1, 2 weeks, everyone is saying no recession, soft landing, markets are going up. It's quite positive last 1 or 2 weeks.
so if we had a chart like that, we'd be able to see that change. So what you're saying is right over the longer term, and then this shorter term, the change, and you can see whether you can invest based on that or whether you're going to find more. What is sentiment? How do you sentiment? Whether you feel good or bad? Yeah.
Yeah, I think the way that this works is that it's an AI analysis of the news. So it looks for positive and negative words. So if you got a lot of
For a specific stock. So we go to Tesla, and basically we have a sentiment graph or to a sector, and you can see here how it evolves through time. It's slow now. Probably is the connection because we are also streaming. So you can go here, and you'll see that it's more exciting than you think because you can see how the sentiment changes through time, and also you can see the hovering news. You'll see now that hovering news appear, and you can see the stories that appear. So for example, you see this spike here, and you can see why you have this spike. So you have a feeling what happened here or here. And you can do the same exactly thing with the charts. So you can go here and you see it's a first time. Basically, I don't check graphs. I'm a fundamental, but I like when I see like a dip or something. What was going there? It might be an interesting time. So there you can go and check what was going on, and that's also very helpful. So we have all those things. You can see the sentiment, and you can see a graph of the sentiment and how it goes through time. Yeah.
I'd really recommend the book Markets Never Forget, but People Do, because Fisher's gone through this, back through history, and he's looked at how the words have changed, like exactly this, at different points in time. And the number of times he's seen the words, this time it's different, come up, have really been an indicator of when it's like a great time to either buy or sell. You know, if people are like, oh, this time it's different, inflation, Ukraine war, whatever it is, you know, oil prices, all that coming together. When you hear that in the news, it's a time to get in there and get hungry, I think, because that'll come up. But definitely recommend that book. But this way of doing things, I think, yeah, it's great if you can leverage that as well. It's all about getting tools, isn't it, for ourselves? Because we're drowning in information, but it's getting that turning it into knowledge, isn't it, rather than just having that information. Information on its own is useless without passing it down to what can we take away? Sentiment? Is it metrics? Is it qualitative? Is it industry sector? Whatever you're looking at, it's about managing to that information. What I find really interesting is when you see a dip and you look at the news flow before that dip, and it might be really negative, and then you sometimes see really negative news and no dip, and it's like this stock Tesla plunged, and you look at it and it hasn't plunged at all, but it went down like 0.5%, but that was deemed to be a plunge by journalists. You've got to remember that journalists are, okay, I used to work in the media. I worked for a news organization, for a channel owned by the Evening Standard when I first started out. And watching those news editors rewrite headlines and stories was fascinating. You know, nothing to do with the story, but the headline just kills it. You're like, that's got nothing to do with it. But they will look for that edge. And if you look the words, if you start reading media and look for those words that are designed to trigger you psychologically, you know, words like plunge, fear, you know, dropping, you know, those you know what they are, those keywords, and you'll see what they're trying to do is trying to get you to click on that story. And a lot of the time, bedded down, look at the end paragraphs. It's like when you start with an annual report, start at the end. Don't start at the beginning, because that's where all the fun stuff is in the notes. That's where the dirty stuff is. It's the same with the story. Go to the end of the story and they say, oh, by the way, actually, earnings weren't that bad. You know, it's just in one sector of something. So it's always important to be aware of that, I think, in that way. Okay, any other? Yeah.
Yeah, so just on the, it's good to consider people's incentives whenever they're speaking to you about something. So journalists, obviously, their incentive is to get you to click on it and read it. So they want their attention is getting, their incentive is getting attention. So whenever I'm looking at another company, I will never look at the investor presentation first. In fact, I probably might not look at the investor presentation at all. But start off with looking at the kind of financials of the company, then read the annual report and read the whole way through the annual report and all the comments and stuff as well, and the the notes to the accounts and everything. Because I think it's a good principle. Never let your first impression of a stock be what the management want you to hear. There's so many stocks you can look at what a really good exercise is to look at a company that you know is struggling and then go and read the investor presentation. And it's amazing how the management can kind of paint things to be very positive when actually maybe they're headed for bankruptcy sometimes. So yeah.
So Stephen, how much weight do you give insider buying or directors' dealings? Is it one of the first things you look at, or?
Thanks. That's I guess an interesting question. I don't necessarily put a huge amount of weight on insider buying. I tend to look at small cap value stocks, and sometimes, they're not managed by their founders, or they maybe don't have a lot of resources to buy huge amounts of shares. Um, I don't think it's critical, because if you had a, insiders can be wrong in terms of buying stock, and they can sell stock for reasons which, maybe they've got something going on in their personal life, they need to sell the stock. So, um, if there was a massive kind of buy or sell, I would look at that. And I do look at who owns the company in terms of institutions and insiders. Because if you've got a company where, it's a controlled company, so they own more than half the company, then that's very different because what they want to do is what's going to happen then. So that can be very good or very bad, depending on the management and their track record and everything. So insider ownership over 50% is very, or, approaching like 50%, and definitely over 50% is very important. In terms of buys or sells, I don't look at it so much. Yeah. So there's one down here first, sorry.
I've just got a couple of questions on Vertu. So obviously, just going back to their profitability, is 1% operating margin quite standard of these companies? And if not, is that perhaps the reason why they're very cheap? Maybe people are a bit scared of that kind of number. And then the second question is, when looking at book value, in this case, well, as you say, maybe a few weeks ago it was 0.5, now it's 1. Instead of looking at it as just it's cheap, to what extent do you look at it as a potential restructuring opportunity where if a company goes bust and there's a fire sale in their assets, in this case, let's say it's dealerships, land, etc., people do profit from those kind of situations if they're trading on the market at that kind of multiple, and then they say, well, even if the company does go bust, I'm still going to make money from its assets. Have you thought about any of that before? Or I realize the second question was quite long, so you can.
That's fine. Well, it's kind of like a margin of safety thing. So if you have a low price to book, below 1, but if you've got a lot of assets on your balance sheet, then, when COVID comes along, they were able to borrow money and continue on. Or they can leverage up their balance sheet to buy other car dealerships, which they did recently a little bit. So it's kind of like it's having a lot of assets in your balance sheet is helpful for that. It's less risky. And your first question?
Just about sorry, it was just about the 1% operating margin. Is that standard of car dealers? And if not, is that perhaps the reason?
Yeah, so Vertu were until they bought Helston, they were predominantly non-premium cars, so like lower cars in the market, and those car dealers seem to operate on margins around about 1%. I did in the comparison table there. That is more standard. So initially, when I looked at the company, I was a bit scared of that because I thought, well, what if if there's a 1% change and then they got no profits. But actually, if you look at their this coefficient of variation, which is like the standard deviation normalized to the mean, then it's actually a very stable 1%. It's not going up and down much at all from 1%. So that gave me some reassurance.
So this is specific to something you mentioned on your slides about ESG. So you mentioned that you care about it and it's something that you look for. Is it a subjective way that you evaluate whether a company is ESG friendly or not, or is there a way that you try to figure out whether or not you'd consider it ESG from the perspective of other investors? Because obviously ESG probably attracts more flows in terms of, maybe there's more ESG funds and there's more money going into them and things like that. So like that's obviously a positive. But then how exactly do you judge whether a company is ESG or not? So, because I guess it could be very subjective and you could argue every single company one way or another to be either, ESG, ESG approved or ESG unapproved, so to speak.
Okay, thanks. I'm not running a fund, so I don't have to report to um, people on my ESG policy, but I do have a policy which is kind of like socially responsible investing. So it's an exclusionary policy. So rather than looking specifically for companies which have sort of good ESG, I exclude certain companies which I feel are doing bad things. So I personally, my conscience, I wouldn't be able to buy a tobacco company because I know that their product is killing people. So I don't want to profit from that. Arms companies as well. There's some more arguments for arms companies perhaps. And then and gambling as well, because again, that's more of a gray one, but they do a lot of harm in some ways. And then companies that manufacture alcohol primarily is their primary business. I personally don't invest in that, which is again more of a gray area. So yeah, it's an exclusionary rather than finding companies which are good for ESG specifically. Yeah.
Can I just quickly on this one? How do you feel about companies which have large holdings of stocks which might be invested in those companies? How far down can you take it? Because you might buy a company which is clean, and then you look at their equity investments and their like tobacco, arms, or maybe they're investing in an index which is full of. I mean, if you invest in the FTSE 100, you're going to get BAE Systems, you're going to get, Imperial Brands, you're going to get all that kind of stuff. How far do you go with that when you look at that?
Well, I believe there was a point at which the Church of England found that they were actually invested in tobacco and other things. So yeah, it can happen to people who would say that they would want to invest in good stuff. So for this investing with real worth stocks, I'm investing in microcaps, really, like small companies. They don't tend to have equity holdings in other companies. So it's not really so much of an issue for me.
If they did, if you found that they were,
Yeah, I mean, if they had a really big equity holding in a tobacco company, I probably wouldn't want to do that. Wouldn't want to buy those. But I'm also an employee. I work for a company and I have a pension scheme. And that pension scheme, has different funds, and that's more of an issue there. So I look at the funds that I'm invested in. I have some tracker funds in that because I can't choose individual stocks for that pension scheme. So I have to pick mutual funds. So I do have some indexes which have small components, defense and other things. And then I've got some more ESG focused ones as well. So
move it to a SIP. State to contribute to that.
I work for a large multinational and yeah, I work for a big yeah. I work for a big multinational and I haven't asked them actually about that, but I could ask them about that. So.
Would that give you more control? That would also mean that you could then use that as part of your own portfolio, and you know how badly pensions perform. I mean, general pension funds are just so far.
I wanted to ask, you presented and specifically stressed out that Vertu Motors has is a freeholder. How would you interpret that in the context of car retailer?
I'm sorry, I'm not quite sure what you're asking with your question. Can you say it again?
And why is that positive thing for a car retailer to own, to be a freeholder?
As opposed to leasing all our dealerships? Well, I would say that I guess if they leased all their dealerships, then it would be very risky business because there's all the thing. And then they take on more and more debt, and then maybe they go bankrupt. The US car dealers, they are more leveraged. So I guess I haven't looked at them in a lot of detail, but you could look at the US car dealers as an alternative model where they're more leveraged. Like Sonic is about 1.75 billion market cap, I think, and it's 1.5 billion in debt. So it's got a lot more leverage than like Vertu does. So.
I'll make just one quick comment, nothing about Virtue. It is about Berkshire Hathaway. Some of us here have been to the AGM. Munger turned 99, Buffett turned 92. Munger is going strong, Buffett is struggling to catch up. So those who haven't been to Omaha, I seriously recommend to look up flights tonight, look up Airbnb and go. And if you think like, it's expensive, if you are a serious value investor, think when you'll be 75. And if you don't go, will you regret it? Right?
From experience, what is the
You remember I did a whole presentation on this. So maybe I'll come one. So I'm a friend of Rusbe. I pop in once in a while. So maybe I'll do a presentation on why you should go, because I did one already. So I don't have to reproduce the materials. But yeah, it's definitely. So please don't forget, right? It's so I know some of my friends are going this year as well. So in case someone wants to get in touch, I can put you in touch with people. So yeah. Doesn't matter. Like I paid like God knows how many dollars for a very shitty room, but no one really stays in the room because you go there and you're. Yeah, but by the afternoon, but by the afternoon, you can go into the main auditorium. You pretty much can get a selfie. I was telling people here, you can get a selfie with Buffett if you're smart. You will have a security guards in the picture, but you know where he is all the time and you can get very close to him. So yeah. But that's for serious value investors, which I assume, given the value investing club this is, and people on Zoom, please think about it. Yeah. Rusbe knows about this because he asked me to do this presentation when I went there. So yeah. I have read that paper actually. I didn't want to say it, but I think that's rubbish. Yeah. So yeah, and I think maybe my presentation is already there on your site, right? Must be from. Yeah. So if you look up City Falcon, I think it's a 2019 presentation, so 3 years back. Um, I did a presentation just on why you should go to Berkshire Hathaway AGM. Okay, so different sort of presentation, but yeah, please. Thank you.
So I want to ask a combined questions to both of you, and also I want to encourage like people that even they are newcomers, they have no experience, and they want to ask something because here there are some people that they're more experienced. Whatever they want to ask, like about our experiences, or like feel free to talk about it, and soon we will close, like, and we will just mingle in a free way so we can meet each other. And so the combined question. Um, I haven't analyzed it, but very statistically, I came up to Subaru. Basically, I asked my nephew, and I told him like, tell me a few, and he likes Japanese cars, and he told me a few names, and I just quickly checked. And then when I saw Subaru, and like they are having cars, maybe 60-70% on top of my head now, 60-70% is cash of the market cap, and okay, even if they don't have a lot of earnings, if they have some, but if they are cheap, and if they return back to some good earnings, I don't know if it has come up to your that you don't screen for I don't know, Japanese companies, but does anybody? That's why it's a combined question. It's because it combines the auto sector that you might know something by like general knowledge, and you if it has come up. So nothing. Does anybody know Subaru or wanna? Okay. Okay. So any other question? Any general question or any newcomer? Somebody who hasn't asked? Yeah.
So about the car, sorry, the car dealership, because I know that automotive, it's historically has been like cyclical. So if you read like Peter Lynch, he made a fortune out of General Motors, Chrysler, just out of the the recession, the crisis. So aren't you worried that we're entering like a global recession in one of the so like Europe, the US? What if people cannot afford to buy more expensive cars? Aren't this sector going to suffer? What's your point of view?
Thanks for the question. Yeah, that's a good question. Well, I would draw a distinction between car dealerships and car manufacturers. So, car manufacturers may be much more cyclical than a car dealership. So, manufacturers kind of build up of inventory and so on, whereas car dealership maybe won't do that as much. In the last recession, your Vertu was formed in 2006, so just before the great financial crisis. So they actually made a profit, like a small profit, but they were profitable through that recession. So I had a look at that and using Sherlock Holmes actually, which I also subscribe to. Um, yeah, so they were okay through that. And a large portion of their profits, 50% of their gross margin comes from after sales, which continues on because of the cars already there. And then there's doing about a third in used cars as well. So if there's a dip in demand for new cars for a couple of years, that doesn't hurt them too much. And it might even help them in the used car prices and so on, as I mentioned before.
I want to come back to your point about Buffett's alpha. I'd really like to know why you think it's rubbish. No, because it's great because I might learn. Hey, well, if I've got it wrong, then I'd rather everyone found out briefly what you thought was wrong because I'm going to learn as well.
Yeah, there are. Okay, so I think the problem with academic people or professors is they can come up with a paper because they have to publish it and they have to come up with something which has not been said before. Doesn't make it right. The whole argument of basically he was leveraging the portfolio because of float is incorrect because there are so many insurance companies which use float. None of them have produced returns like Buffett has. Point number one. Point number two, the way Berkshire has been run, there is no other company which has been run that way in terms of having a portfolio of companies which are publicly listed. The way he has set up by it actually being an investment company, he doesn't have to pay taxes. He can take entire dividend out of C's into the holding company, doesn't pay taxes anywhere. So there are lots and lots of arguments which are not taken into consideration in that particular paper. And like I mean the whole corporate governance, right? I mean you think of like, by the way, one of our friends at Value Investing Club, Michael, when he used to present, he used to always compare his performance to Berkshire Hathaway, which I really like, which I myself do, because for us, obviously you can look at S&P 500, but you can also go and buy Berkshire shares and you're probably buying the best fund manager with a proven track record for zero friction cost. So that's the thing about Berkshire, right? Like your friction cost or agency cost is minimal, right? And yeah, and plus the whole argument around, well, he was using quantitative screenings, this and that. But
No, they're not saying that. Same result.
yeah, but the whole thing is you look at the managers that he got to get those results for him, right? The whole aspect of people who have made money for Berkshire is missing. Ajit Jain made $40 billion for Buffett, single person, right? That paper doesn't go into that. So once you find five or six arguments which are like not even touched upon or not covered, which are producing alpha for him, then in my mind, it's not adequately covered.
So just to mention that the float, the idea that other insurance companies have float and they're not having that result. And that's fair. That's fair. They don't have float, but okay, come in. Yeah, tell us what you think about Buffett's alpha. Yeah. You can join. It's all right. It's not. They do. I mean, that's a kind of a separate issue, I feel, because if you've got float and you produce a certain number, yeah, we can debate it for too long probably. But they also did run they ran a portfolio that was based on these metrics and got the same results as he did. I mean, you can say, okay, we have a manager that produces money. Great. But if you've also got the metrics which do that, then it doesn't matter if it's a manager or not, really. It's what matters at the end of the day is the result. And if you want to question result, that's fine. So
I met many of you people in banking or financial industry, and I've seen so many products launched on back of back testing, right? But you have to think about like why do all these back testing results don't match up with actual results, right? And like the entire investment banking industry is about this. Right? Yeah, so there is something about there is something about trying to reduce it to just numbers. The whole yeah, maybe whatever it is, but it doesn't work that way, right? The stock markets don't work that way, or maybe the world is just too complicated to just put things only in numbers and say, if you follow these formulas, this is the result you'll get, right? But it doesn't happen. It happens in the back testing, but doesn't happen in actual results.
I have a general opinion on that. Like, when you try to make a good return, it's like cooking. So you add elements, and in certain elements, like when you're a small investor, you have some advantages according your brain and your psychology. Some people are very analytical. Some other people are very strong psychologically, like they can stick with something. So everyone, we have our strengths, and for each person, by subtracting or adding things, it doesn't mean that it will add to the performance. So, I mean, we can argue about what is sustainable and what is not, and it's very difficult to know. But if something, happens for years, then it's sustainable, right? So my point is that, like, we can argue, but basically for different people, something that can work for me, it might not work for Zach. Something that works for you. So so it's interesting always to see what is the. So I always want to know, like, what is the good point, like the what I can take from there. Does it match me? Does it match my style? What I can take from what you said about quality, and I think it's a game that you have to adjust for your personality, and that's why this sometimes, like, so I guess that we all can learn, and then we keep what produces the results for us. So it's not an absolute. Yeah. Yeah.
Spoken about it. And what he says is quite interesting. He says like every 10 years, people or markets believe in certain methods, right? And 50 years ago, it was a whole price to book and Graham formulas. And then there were magic formulas. There was this whole P thing. There was tech thing, PEG thing. And he argues that it's not that it's right or wrong, right? But every 10, 15 years, people believe that there is certain way to value markets, right?
But you agree. Feedback say that
Yeah, and
different because he said that, for example.
yeah, yeah.
So you see, there's always a common ground.
I'm actually stuck and I bought it on Hilton, so I'm not averse to his Berkshire stocks. I mean, it's given. It should be in there anyway, so it's always good.
So guys, what we can So now, guys, what we can do is that we can continue the discussion in a free way. Offline, we can drink, and we can just mingle in a free way. I mean, I enjoyed the conversation. Like, I like always speeches, but also the strategy, and it was something that I'm very much interested into. And then all your questions and all the vibes, and like it was great time for me. I enjoyed it, and I hope that you enjoyed it as well, and also that people online enjoyed it. So now we will close. I'm thanking all of you, and see you next time. Bye bye.